Hello everyone, here is JP, and today we're talking about the market volatility and how you are able to capitalize by selling Vega and Theta in conditions such as the one that we're seeing right now. In practical terms, I'll tell you how to get paid to buy cheaper something that you already want to buy. And with that, let's get into the video. So here we are with the S&P down almost 12% in the last week, and thus we're going to talk about in this video how are you able to navigate this environment and capitalizing with the ideas that you feel like fundamentally a good play long term. The first tip of them all that I have to give you is that you shouldn't overtrade. Particular derivatives in this kind of environment tend to have very big bid-ask spreads, even higher than what they used to have. And thus, trading, even if you do have free commission trading, spreads and crossing the spread several times adds up pretty quickly, even though sometimes you don't actually feel it. Second tip, consider yield strategies with limited risk. And by this I say never sell a naked call. It is never worth the risk. You never know when a company is getting acquired or some black swan happens and it completely destroys your portfolio. So with this said, what I'm trying to tell you is that this kind of strategies where you are able to short Vega and short Theta can actually give you a good solution in order to try to capitalize in high volatility environments such as the one we're seeing right now. Because it will normalize, and it always does. As you can see, the VIX, also known as the fear index, has very big spikes from time to time, and it always tends to revert to the mean. But for the curious one, no, you cannot short the VIX. It's only an indicative index. And although there are ways of shorting it through ETNs, I wouldn't suggest it without looking carefully at the carry costs associated about using those leverage ETNs. However, there are ways to bet that the VIX will normalize, to bet that volatility levels will drop. And for that, I'm showing you Microsoft implied volatility term structure before and after the drop in the SPX in the beginning of the week. And by the way, please, if you like this content, personal finance, entrepreneurship, investments, derivatives, please consider leaving a like and subscribing for more content like this. It really does help a lot. Now moving on. As you can see on the top chart, you have two types of lines, the dashed ones and the continuous ones. The dashed ones represent the implied volatility of Microsoft across every strike. To the left of at the money options, you see the put volatility, and to the right, you see call volatility. These levels change substantially after the market sell-off. As you can see, current implied volatility almost doubled when compared to previous or historical implied volatility before the market sell-off. As you can see, regardless of the level of strikes, moneyness or delta, if you rather call it that, derivative implied volatility spiked ridiculously high. Okay, now here it's an example of an options or a strategy payoff that is composed by a long put with a longer maturity date than the short put that also makes or is part of this strategy. What happens is that effectively you're short theta. Why? Because the decay on your short leg is going to be faster than the decay on your long leg. Additionally, consider the market structure that you've seen before. Usually market volatility tends to go down over time, tends to normalize as we've seen before. And that's what we're trying to do here. When you buy a put with a longer date, the implied volatility of that put is always going to be lower. And the implied volatility of a put that is shorter term is always going to be higher. Okay? So basically, you have a situation where if volatility starts to normalize and time always goes forward, the short position that you have is going to decay way faster and it's going to bleed way faster than the long position that you hold longer term. And by this, I don't mean that a strategy like this is a one-size-fits-all. As you see, if you add a 99% confidence interval to where Microsoft may move based on past returns, you see that most likely this strategy is going to make a profit. Of course, as the great Warren Buffett said, if past history was all that it takes to play the game of money, then all librarians would be rich. Now, you can always tell me that if you bought puts half through this week, you would make money. Yes, you would make money, but it doesn't mean you were not overpaying. Remember, market is made by greed and fear. And once your house is on fire, if you try to insure it against a fire, most likely you're going to overpay because whoever's selling that insurance already knows that your house is already on fire. Meaning, buying puts on a market sell-off, it's almost likely that you're going to overpay and you're going to lose money. The third thing that I want to mention is consider the hidden variables in the market. What do I mean by this is, for instance, bond markets are already at negative yields. A substantial amount of this corporate bond market, it's at very low yields or negative. Imagine the following. If there is a football game and you want to manipulate the end result of the game, why would you do this? Well, you would do this because most likely you have a bet, okay, that a given team is going to win or draw or whatever. But in order for you to win that bet, you want to manipulate the game, meaning you need to pay a player, you need to pay the referee, and in order for you to pay this guy and to make a profit, you need to make more money on the bets than what you need to pay this agent that's going to manipulate the game for you. But the answer there is there has to be liquidity. Now imagine, in terms of markets, that the bond market has low negative interest rates everywhere, that the propension to manipulate and for these funds to seek yield is so extreme that one of the ways they can do it is actually to manipulate equity markets and make some yield in the derivatives market, okay? The thing is, with all these retail interests around derivatives such as options lately, it really has become the paradise for this kind of institutions and funds. Also, after the Dodd-Frank was passed, everything got simpler, counterparty risk is virtually non-existent, and so it almost feels like all of these variables are aligning in order for these institutions to manipulate equity markets, because there is in fact a very high propension in the environment for them to do so, because they really do need these yields. Okay, in current market conditions, there is clearly a lot of fear. Not only because you see it in a fear index, the VIX, you can also feel it in you, most likely. You see markets dropping 3% day after day after day. The SPY even dropped almost 5% the other day, or even dropped 5% the other day, which has never been seen since 2011. So there is clearly that fear that the markets will continue to drop. Now, if you do have some company that you fundamentally like and that has been dropping these last few weeks or this last week, you will most likely see that the put contracts are extremely expensive almost across the board. So this is a very good opportunity, in my opinion, that if you do like a given valuation of an asset that you fundamentally know and you like, to sell that put, always, I must say this, that you should always consider the allocation and the exposure. But given that you are controlling this factor, you can sell a put and actually buy cheaper something that you already are considering buying. Now, in normal conditions, no one is going to pay you this amount of premium in order for you to buy something at a substantially lower price. But in the current conditions, where the market is dropping and you are considering going in, maybe a put contract, a short put contract, will give you the ability to capitalize in this volatility environment in case it normalizes. And if it doesn't, and the equity that or in the asset that you shorted continues to drop, you have the opportunity to buy it at a slower price, and you even got paid for it. Okay, to wrap up the video, the best thing I can really tell you is to take a step back from this market volatility, look at your positions, remember why you bought it in the first place, have a strategy, have a plan. Also, don't follow the market. Remember, the market and your impulse of greed And fear, it's human nature. Okay, so in order to fight it, have a rationale. You always need to remember why you bought and when are you thinking of selling. Okay, remember as well that there are more variables than the dollar amount invested if you're considering derivatives. You have the delta, you have the vega, you have the theta. You should consider all of this, okay, if you're going for a momentum play. Okay, you need to be able to cut your losses if it doesn't go in your direction, because when you invest in a direction, okay, and you use derivatives to have this leverage, you should really consider that there is a theta going against you, that is a vega going against you, and that you shouldn't be with that fear of missing out, that excess greed or that excess fear that will lead you to sell or buy something without a previous plan. So this is really the best advice that I can give you. I hope that you enjoyed the video. And once again, if you like this kind of content, please consider leaving a like and subscribing. There will be more content soon. That's all. Stay safe. Have a great weekend.